Your 401k just lost thousands. The IRS wants their cut in 11 days. The market just had its worst week in years. The Dow dropped over 1,600 points in a single day. The S&P 500 fell nearly 5%. The Nasdaq crashed close to 6%. If you are retired or about to retire, your portfolio just took a hit that most people have not fully processed yet. And here's what nobody on the news is telling you. In 11 days, on April 15th, the IRS expects you to file your taxes. Make your first estimated tax payment for 2026, and if you turned 73 last year, the IRS has already forced you to take a distribution from your retirement account based on what it was worth before the crash. You're being forced to sell low, and the IRS is not going to adjust your bill because the market dropped. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Kevin Retires, and this is what I do. I break down the tax rules, the deadlines, and the financial traps that affect retirees, so you never get blindsided by something you should have been told about. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Now let me explain exactly what happened and why it matters more to retirees than anyone else. On April 2nd, the administration announced sweeping new tariffs on imports from virtually every country. The markets reacted immediately and violently. Within 48 hours, trillions of dollars in value were wiped from the stock market. Energy stocks moved, tech stocks moved, consumer stocks moved. Everything moved. This is not a video about politics. I do not care what side of the aisle you're on. This is about what is happening to your money right now and what you need to do about it before April 15th. If you are 35 and your 401k drops 15%, it stings. But you have decades to recover. You keep contributing every paycheck. You buy shares at lower prices. When the market comes back, and it always has, you end up better off than before. Time is on your side. If you are 68 and you're pulling money from your retirement accounts to live on, a market drop hits completely differently. And I need to explain exactly why, because this is the single most important concept in retirement finance. It is called sequence of returns risk. Here is how it works. Say you retire with $500,000 in your IRA. You are following the 4% rule, withdrawing $20,000 a year to supplement your Social Security. In a normal year, the market returns about 8%. Your portfolio grows, you take your withdrawal, and you are fine. But right now, the market is down. Let us say your portfolio drops 15%. That $500,000 is now worth $425,000, but you still need that $20,000 to pay your bills. So you withdraw it. Now you are at $405,000. Here's the problem. When the market eventually recovers, say it bounces back 15% the following year. 15% of $405,000 is only $60,750. Your portfolio recovers to $465,750. You are still down from where you started, and you need to take another $20,000 withdrawal. Compare that to someone who did not withdraw anything. Their $425,000 recovers to $488,750. They are almost back to even. The difference is your withdrawals. Every dollar you pull out at the bottom is a dollar that can never participate in the recovery. This is why a market crash in the first few years of retirement is so devastating. It is not the drop itself. It is the combination of the drop plus ongoing withdrawals. It creates a downward spiral that is very hard to recover from. And it gets worse. Because right now, retirees are not just dealing with the portfolio decline. They're dealing with rising costs at the exact same time. Your Social Security got a 2.8% cost of living adjustment this year. Sounds decent, right? Except Medicare Part B premiums jumped 9.7%, from $185 a month to $202.90. Since most retirees have Medicare deducted directly from their Social Security check, many of you are actually receiving less money each month than you did in 2025. Now add gas up 33% in a month, groceries going up, heating bills going up, and your portfolio down 10 to 15%. You are getting squeezed from every direction. Now let me walk you through 5 real situations that are happening to retirees right now this week. Scenario 1, you're 74 years old. You have a traditional IRA worth $500,000 as of December 31st, 2025. Your required minimum distribution for 2026 is calculated based on that number, roughly $19,200. But after the tariff crash, your account is now worth about $425,000. You still have to withdraw $19,200. The IRS does not care that the market dropped. Your RMD was locked, and based on the December balance, you are selling more shares at lower prices to meet a withdrawal amount that was set when your account was worth more. It is like the IRS is making you sell low, and you have no choice. If you do not take your RMD, the penalty is 25% of the amount you failed to withdraw under the Secure 2.0 Act. It drops to 10% if you correct it within 2 years. But that is still a massive penalty, so most people just take the distribution and eat the loss. Scenario 2. You are 68. You and your spouse watch your portfolio drop 15% this week. You panic. You call your broker and move everything to cash. You feel safer. You just made the second biggest mistake a retiree can make. Let me give you some perspective. During the Gulf War in 1990, the S&P 500 dropped 20%. Within a year, it had fully recovered. After September 11th, the market dropped 12% in a single week. Within 2 months, it was back. During COVID, in March 2020, the market crashed 34%. By August, it had fully recovered. Every single time, the people who panicked and sold missed the recovery. The people who stayed in were fine. When you sell at the bottom, you turn a temporary decline into a permanent one. You lock in your losses forever. And when the market bounces back, you're sitting in cash, watching everyone else recover. Do not be that person. Scenario 3. This one is the opportunity hiding inside the chaos, and it is the reason I needed to get this video out right now. You are 66 years old. You have $200,000 in a traditional IRA. The market is down 15%. Your account is worth $170,000. If you convert $50,000 to a Roth IRA right now, you pay income tax on $50,000. That is the tax hit. But here's what happens next. When the market recovers, say it bounces back 20% over the next 2 years, that $50,000 grows to $60,000 inside the Roth, and that $10,000 in growth is completely tax-free, forever. No taxes when you withdraw it. No required minimum distributions during your lifetime. The IRS never touches that money again. If you had waited until the market recovered to convert, you would be converting $60,000 and paying tax on the full amount. The down market saved you real money. You pay tax on $50,000 instead of $60,000. At a 22% bracket, that is $2,200 in savings just from timing. Let me put a bigger number on this. Say you convert $150,000 over 3 years while the market is depressed, paying an average of 12% tax. You spend about $18,000 in taxes. But that $150,000 withdrawn over 10 years of retirement from the Roth saves you from approximately $4,000 to $5,000 per year in taxes. Over a decade, that is $40,000 to $50,000 in savings. You paid $18,000 to save $45,000. That is a 2.5 to 1 return on your tax payment. This is what wealthy retirees do in every downturn. They convert aggressively while prices are low. They pay less tax now to avoid more tax later. Talk to your tax advisor about this. Not next month. This week. Every day you wait is a day the market could recover and the window closes. Scenario 4. You are a newly retired 67-year-old. You left your job last year. No employer is withholding taxes from your paycheck anymore because you do not have a paycheck. Your income now comes from Social Security, IRA withdrawals, a small pension, and some dividend income. Here's the problem. Most of those income sources do not automatically withhold the right amount of tax. Social Security withholds a flat percentage if you ask it to, but it is usually not enough. IRA withdrawals often have a default 10% withholding, but your actual tax rate might be 22%. Pension withholding varies wildly. The IRS expects you to make up the difference through estimated tax payments, 4 times a year. The first one for 2026 is due April 15th. That is 11 days from now. If you miss it, the IRS charges a penalty of approximately 7 to 8% annually on the underpaid amount, calculated quarterly. On a $6,000 underpayment, you're looking at $300 to $500 in penalties by the time you file next year. Nobody told you this when you retired. The IRS did not send you a welcome to retirement letter explaining the rules. They just expect you to know. The safe harbor rule says, if you pay 100% of last year's tax through withholding and estimated payments, 110%, if your income was above $150,000, you will not be penalized no matter what. Go to irs.gov/payments. Set it up today. 5 minutes now saves you hundreds later. Scenario 5. You're 69 years old. You filed your 2025 return in February. Your tax preparer used a standard software package. You paid your bill and moved on. But nobody applied the $6,000 senior bonus deduction from the One Big Beautiful Bill. This deduction is brand new. It was created for taxpayers age 65 and older. $6,000 per person. $12,000 for a married couple filing jointly where both spouses qualify. It is on top of the regular standard deduction and the existing senior additional deduction. It did not exist before 2025. It was buried in an 1,100-page bill, and some tax software is still not flagging it automatically. The income limits are $75,000 for single filers and $150,000 for married filing jointly. Below those limits, you get the full deduction. At a 22% bracket, that $6,000 saves you $1,320. For a married couple, the $12,000 saves $2,640. If you already filed without it, you can file an amended return within 3 years using Form 1040X. Do not leave that money with the IRS. Ask your preparer this exact question. Did you apply the senior bonus deduction from the One Big Beautiful Bill on my return? If they give you a blank stare, that is your answer. Find someone who knows what they're doing. Now let me talk about what you should actually be doing right now. Not what the headlines say, not what your neighbor says, what actually protects your money in the next 11 days and beyond. Here's your action checklist. 7 things to do this week. 1. Do not panic sell. I know it is scary. I know watching your account drop feels like the world is ending. But the market has recovered from every war, every crisis, and every crash in American history. The Gulf War, September 11th, the 2008 financial crisis, COVID, every single time it came back. This time is unlikely to be different, but it only works if you are still invested when the recovery happens. 2. Use your cash reserves. If you have a savings account, a money market fund, or CDs that are maturing, this is exactly what they're for. Use your cash to cover living expenses instead of selling investments at a loss. Financial planners recommend keeping 1 to 2 years of expenses in cash for exactly this situation. If you have that cushion, now is the time to use it. 3. If you must take an RMD, consider a qualified charitable distribution. If you are 70 and a half or older, you can donate up to $111,000 directly from your IRA to a qualifying charity. The donation counts toward your RMD, but it does not count as taxable income. It does not increase your adjusted gross income. It does not push more of your Social Security into the taxable zone. If you were going to give to charity anyway, route it through a QCD. Same donation, dramatically better tax result. Most brokerages make this easy. You fill out a form, designate the charity, and they send the money directly. 4. Talk to your tax advisor about a Roth conversion this week. A down market is the best time to convert. You pay tax on a lower amount. All future growth is tax-free. No RMDs during your lifetime. The math works heavily in your favor when prices are depressed, but this window only exists while the market is down. Do not wait until things feel safe. By then, the opportunity is gone. 5. Make your first 2026 estimated tax payment by April 15th. If you owed more than $1,000 on your 2025 return after withholding, you almost certainly need to make quarterly payments. Go to irs.gov/payments. 5 minutes now saves you hundreds in penalties later. 6. Claim the $6,000 senior bonus deduction. If you are 65 or older with modified adjusted gross income under 75,000 single or 150,000 joint, you qualify. It goes on the new Schedule 1A. Make sure it is on your 2025 return. If you already filed without it, file an amended return. You have 3 years. 7. Review your overall allocation. If this downturn is keeping you up at night, it might be a signal that your portfolio is too aggressive for your stage of life. A retired person should not have the same stock-to-bond ratio as a 30-year-old. After the dust settles, sit down with your financial advisor and make sure your allocation matches your actual risk tolerance, not the risk tolerance you thought you had when the market was going up. Let me bring it all together. The market just crashed. Your portfolio is down. Gas prices are up 33% in a month. Your Social Security got a 2.8% raise this year, but Medicare premiums jumped nearly 10%. So many of you are actually taking home less than you did last year. And in 11 days, the IRS expects you to file your taxes, make your estimated payment, and take distributions from accounts that are worth less than they were 3 months ago. You cannot control the tariffs. You cannot control oil prices. You cannot control what the Federal Reserve does, but you can control how you respond. Do not panic sell. Use your cash reserves. Look into Roth conversions while the market is down. Make your estimated payment. Claim the senior deduction. And if you have RMDs, consider a qualified charitable distribution. The people who come out of this in the best shape will not be the ones who predicted the market bottom. They will be the ones who had a plan and stuck to it. This is Kevin Retires. Every week, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If this video helped you, do me a favor, hit the like button. It takes 1 second and it helps this video reach more retirees who need to hear it. And if you're not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. The next video I am working on is going to save some of you thousands of dollars. I do not want you to miss it. If you know someone who is retired or about to retire and they are watching their portfolio drop right now, send them this video. 11 days. That is what they have before April 15th. And the difference between reacting with fear and reacting with a plan could be tens of thousands of dollars over the next decade. Drop a comment. Is this crash affecting your retirement plans? What is your biggest financial concern right now? I read every single one, and whatever comes up most is what the next video covers. I will see you in the next one.